Is that rally and the broader market bounce justified? Well, joining us now is Aswath Damodaran, Wall Street's Dean of Valuation, Professor of Finance at the NYU School of Business. Always good to see you. So Nvidia looks stretched. Does that mean you sell it?
I think it's a dangerous game to play. If you don't own it, the only way you can sell it is to short the stock, and that's a recipe for disaster, especially leading into an earnings report. And the way to think about Nvidia is, are you a trader? In which case, you buy at a low price and sell at a high price, and Nvidia might be the game you want to play. Are you an investor, where you're buying based on earnings and cash flows? Nvidia is an amazing company, great growth, amazing cash flows, superb margins, but you're paying a premium price even given all of those pluses. So I think you've got to be honest with yourself about the game you came to play.
So, and broaden that out for the whole market. You make an interesting point here. You say hubris is the greatest sin in investing, the excessive pride. And when people use the word bubble, it tends to be a sign of hubris. Explain.
I think that when you use the word bubble, you're essentially arguing that the rest of the market has lost its mind. And that, to begin with, is a sign of an ego that's out of control. When you think something is overvalued, all it means is you think it's overvalued. It doesn't mean it's overvalued. It doesn't mean you have the truth. You have your truth and you've got to act on it, but the rest of the world has their own truth. So my view on investing is make your own judgments, but don't pass judgment on other people buying or selling stocks because you don't like what they pay.
So in your judgment, among some of the mega cap stocks, what's a better deal right now?
I think Amazon is a better deal than Nvidia. As an investor, if you wanted to go with the mega tech, I think Amazon is a better buy than Nvidia. It might not play out that way as a trade, but I think given the earnings and the cash flows, if I had to buy a stock now and you force me to buy a big tech, I would rather own Amazon or buy Amazon than buy Nvidia right now.
How are you valuing small cap stocks, which have performed not as well as mega cap names that we've been discussing so far? And when should investors, not traders, but investors, start charting out narratives that make sense to them where those are concerned?
I think a lot of people believe in mean reversion, which is they assume that if small caps have underperformed for a while, they've got to come back. I'm going to posit that there's been an economic shift, that the way the economy is structured is you have more winner-take-all businesses, which effectively put smaller companies at a disadvantage. So one reason why I think small cap stocks have underperformed larger cap stocks, not just over the last few months, but over the last decade, is because the market seems to have come to that realization as well. It might have overcorrected, and there might be some kind of a reversion back at least to a more normal pricing. But I'm going to argue that those people who expect the old small cap premium, small caps historically have delivered higher returns than large caps to come back, might be barking up the wrong tree.
I mean, it's an interesting point when you think about what's happened to salaries, to incomes in our society, right? The inequality, the wealthy have tended to get wealthier, and the working class hasn't fared so well. If you looked at income the same way you looked at stocks, you would expect, well, eventually, the working class has to catch up, and it doesn't work that way.
Not quite, and especially in business, because if your economy is structured with 3 or 4 winners in every sector, what is it in the economy that's going to force the smaller companies or allow the smaller companies to catch up? It just doesn't work for them.
Now, what about playing the sector game? There are certain historical tendencies during cycles. Is that similarly dangerous to expect that because something is happening in the macro environment, certain sectors are a better value or worse?
I think in hindsight, there's always sector rotation. In hindsight, we can always say, if only I'd done that. I've looked at sector investing over time, and if you can rotate sectors well, all the more power to you. I just don't have that capacity. I find myself constantly second-guessing myself. So I think you can look at sectors, and I think you can make some judgments. Right now, for instance, if you think interest rates are going to continue to fall, and they have already, then you're going to see utilities benefit from the fact that rates are lower. So you can make a macro bet with sectors, but beyond that, there's not much you can do.